You finally managed to save $10,000. For a lot of people, that's not easy money. That's years of saying no to things, watching your spending, and trying not to touch your savings. But then you look at your debt and realize you still owe $10,000. So what do? Pay it off and finally breathe a little easier, or invest the money and hope it grows faster than your debt costs you? At first, the answer seems pretty obvious, but run the numbers over the next 10 or 20 years, and the answer gets a lot more interesting, because the financially smarter choice isn't always the one that feels better today. Chapter 1. The guaranteed versus the uncertain. Let's make this real. $10,000 sitting in savings, $10,000 owed on high-interest debt, the kind that's charging you 20% a year, whether it's a credit card, a personal loan, doesn't matter. Pay it off and you've handed yourself a guaranteed win. No betting on what the market does next year, no hoping the S&P 500 has a good run. You just stop paying that 20%. No more balance hanging over your head, no more opening a statement and thinking, how did this get so expensive? Now flip it. You skip the debt. Put the $10,000 into the market instead, and say you earn the historical average, around 10% a year. At first, that sounds like a smart move. Your money's working. Maybe that $10,000 becomes $20,000, then $30,000 over enough years. But there's a problem hiding under that math. Your investment is growing at one rate, your debt is charging you at another. And unlike the return you're hoping for, the interest on that debt isn't a maybe. It's happening every single month, whether the market goes up or down. Debt costing 20%, investment making 10%, you're not building wealth. You're trying to outrun a hole that's growing faster than you are. So the real question isn't, can the market beat my debt? It's, why would I take on a highly uncertain return when a guaranteed cost is already eating my money? That's the part people miss. Paying off a 20% debt doesn't come with a notification saying, you earned 20% today. There's no exciting number on a chart. You just quietly stop losing money. And that's easy to underestimate precisely because it doesn't feel like a win. But now let's make this more realistic. Because not all debt costs 20%. What if it's 8% or 5% or lower? Now it actually gets hard, because at that rate, investing starts looking a lot more reasonable, and the old advice, always pay off debt first, starts falling apart. Interest rate matters, type of debt matters, taxes matter, your emergency savings matter, and if there's an employer match sitting on the table, that changes the math again too. There's no single answer that works for everyone, but here's what we can say with confidence. If the debt is expensive enough, putting money into an uncertain investment while that debt keeps charging you is a very hard trade to justify. Paying it off wins for now, but what happens when the debt isn't 20%, when it's 5%, and that same $10,000 could compound for decades instead? That's where it stops being simple. Now let's change just one thing. Same $10,000, same person, same goal. But instead of 20%, let's say the debt costs 5%. Suddenly, paying it off doesn't feel quite as obvious. Because now you have a choice. You could take your $10,000, wipe out the debt, and lock in that 5% saving. Or you could keep the debt and invest the $10,000 instead. And this is where people usually make a mistake. They look at historical stock market returns. The S&P 500 has averaged somewhere around 10% a year over the long run, and think, why would I pay off a 5% debt instead of chasing that? It sounds logical, but there's a catch. That 10% is an average spread across decades, and it's never guaranteed for any single year. The 5% you save by paying off debt isn't an average. It's locked in the moment you pay. You could have a great decade in the market. You could also invest right before a major decline. Either way, you won't know until it's already happened, and that emotional side of this decision starts to matter more than the math. Imagine you choose to invest. 6 months later, your $10,000 becomes $8,000. Your debt is still there. The interest is still there. And now you're looking at a portfolio that's down 20%. Technically, nothing has gone wrong with the long-term plan. But emotionally, it can feel very different. You might start thinking, maybe I should have just paid off the debt. Now imagine the opposite. You use the $10,000 to eliminate the debt. A year later, the stock market is up 20%. Suddenly you're thinking, I could have made $2,000. And that's the trap. Both decisions can make you regret the one you didn't make because you're comparing your real outcome to an imaginary alternative, and that imaginary alternative always looks perfect. This is why the question isn't simply which one has the higher expected return. You also have to ask which decision can I actually stick with? Because a mathematically superior strategy doesn't help much if you abandon it halfway through. Let's say you decide to invest instead. You promise yourself you'll keep putting money in every month, then the market falls 30%. Are you still going to invest, or will you stop? Maybe you'll even sell. If that happens, the spreadsheet you started with no longer describes your real life. And that's one of the most overlooked parts of personal finance. Behavior can completely change the math. Paying off debt has a psychological advantage an investment account doesn't always have. The balance goes down, the interest disappears, and every month you can see progress. $10,000 to $7,000 to $4,000 to $0. It's simple, it's visible, it's finished. Investing is different. You might put $10,000 in and watch it become $11,000, then $9,000, then $12,000. There's no straight line. And if you hate uncertainty, that volatility can make the better mathematical choice much harder to actually follow through on. But here's where the story turns again, because there's one situation where investing becomes extremely hard to ignore. Imagine your employer offers a 401k match. You put in $1 and your employer adds money on top of it, often 50 cents, sometimes a full dollar for every dollar you contribute, up to a limit. That's not a maybe, that's not a market average you're hoping for. That's an immediate, guaranteed return most investments can't touch. 50%, sometimes 100% the moment you contribute. Now you're not just comparing a 5% debt against an uncertain market return. You're potentially turning down free money by skipping it. And that changes the decision. Suddenly, the smartest move isn't picking one side completely. It's get the employer match first, then attack the debt, then increase your investing. And that's the bigger lesson we're starting to uncover. This isn't really a battle between debt and investing. It's a battle between different uses of the same dollar. Every dollar can do only one thing at a time. It can reduce interest, it can buy an investment, it can build an emergency fund, or it can just sit in your bank account. The real question is, which job gives that dollar the most value for your situation? And once you look at it that way, the answer gets a lot less obvious, because we haven't even considered the most expensive debt of all yet, the kind that can quietly turn a $10,000 balance into a financial treadmill: credit card debt. Now let's look at the kind of debt that can completely change this decision: credit card debt. Suppose you have $10,000 invested in the market, but you also have $10,000 sitting on a credit card charging you 20% interest, which, by the way, is close to the actual national average. Most credit cards today charge somewhere between 20 and 25%. Your investment might go up, it might go down, but your credit card company isn't waiting to see what the market does. The interest keeps running. And this is where the idea of investing instead of paying debt starts to break down. If you're paying 20% on a balance, your investment doesn't just need to make money, it needs to outperform that debt cost after taxes, fees, and the risk that the return doesn't arrive when you need it. That's a much harder game. There's another problem too, and it's psychological. High-interest debt follows you around. You get your paycheck, part of it goes towards interest. You make a payment, the balance comes down. Then interest gets added again. It can feel like you're running on a treadmill, working hard, making payments, but the finish line keeps moving. Now imagine the opposite. You take that $10,000 and wipe out the credit card balance. For the first time in years, you owe zero. That doesn't make you richer overnight, but it changes your monthly cash flow. The money that was going towards interest can now go somewhere else: your emergency fund, your retirement account, your brokerage account, or just breathing room. And that's something a spreadsheet can easily miss. Cash flow has value. A debt-free person may have less invested today, but more money available every month to invest from this point forward. That's why paying off high-interest debt can create a kind of snowball. You eliminate the expensive debt, that frees up cash, the cash gets invested, the investments compound, and eventually the money that used to disappear into interest starts working for you instead. But now let's make this more realistic. What if you don't have an emergency fund? This is where another mistake happens. Someone hears, pay off your debt, throws every dollar at the balance and leaves themselves with zero in cash. Then the car breaks down, or the roof leaks, or their hours get cut, and they're reaching for the credit card again. Now paying off debt only to create new debt. That's not progress, that's just moving money around. So before asking, should I invest to debt, there's a question that comes first. How financially fragile am I right now? Because having $10,000 invested in the market while having no emergency savings means you may technically own assets, but still be one unexpected bill away from borrowing money at a very high rate. That's why a solid plan usually has an order to it. Enough cash for genuine emergencies first. Then, if there's an employer match on the table, grab that. It's free money, and turning it down is like leaving part of your paycheck behind. Then attack the expensive debt. Then build long-term investments. The exact order can shift depending on the person, but the principle stays the same. Don't build wealth with one hand while expensive debt quietly destroys it with the other. And this brings us to a more interesting question. What happens if the debt isn't expensive? What if it's a 3% mortgage? Now paying it off gives you a guaranteed 3% saving, but investing that same money could earn considerably more over time. At that point, the decision gets a lot less obvious. So maybe the real question was never just debt or investing. Maybe it's what kind of debt do you have and what are you giving up by paying it off or not? And once you start asking that, the answer gets a lot less obvious than a simple rule. Because the same $10,000 can produce completely different outcomes depending on the person holding it. And that's exactly what we're going to test next. Same $10,000, different person holding it, and that's where most financial advice falls apart. Meet person 1, $10,000 in credit card debt at 22%, close to today's national average. No emergency fund, no retirement savings, a paycheck that barely covers the month. Meet person 2, same $10,000, but debt only 3%. 6 months of expenses saved, stable income, and an employer who matches the first $5,000 they put into their 401k, dollar for dollar. Same number, completely different situations. For person 1, paying off that debt is the priority. Every month they wait, 22% keeps compounding against them. There's no investment that reliably beats that. For person 2, it's not so simple. If they put in $5,000 and their employer matches it with another $5,000, that's an instant guaranteed return most investments can't touch. 50%, sometimes 100%, the moment they contribute. Now you're not just comparing a 5% debt against an uncertain market return. You're potentially turning down free money by skipping it. And that changes the decision. Suddenly, the smartest move isn't picking one side completely. It's get the employer match first, then attack the debt, then increase your investing. And that's the bigger lesson we're starting to uncover. This isn't really a battle between debt and investing. It's a battle between different uses of the same dollar. Every dollar can do only one thing at a time. It can reduce interest, it can buy an investment, it can build an emergency fund, or it can just sit in your bank account. The real question is, which job gives that dollar the most value for your situation? And once you look at it that way, the answer gets a lot less obvious, because we haven't even considered the most expensive debt of all yet, the kind that can quietly turn a $10,000 balance into a financial treadmill, credit card debt. Now let's look at the kind of debt that can completely change this decision. Credit card debt. Suppose you have $10,000 invested in the market, but you also have $10,000 sitting on a credit card charging you 20% interest, which, by the way, is close to the actual national average. Most credit cards today charge somewhere between 20 and 25%. So far, the math has been relatively clean. Debt has an interest rate, investments have a potential return. You compare the two, make a decision. But real life doesn't stay on a spreadsheet. Remember the version where the market fell 30% and your $10,000 became $7,000 while the debt just sat there, interest still running? That's the moment people discover whether they actually had a long-term plan or just a short-term hope. Easy to say I'm investing for the long run when the account's going up. Much harder when you're staring at a real loss and thinking, maybe I should just sell. And if you sell because the market fell, you haven't just taken a temporary dip, you've turned it into a permanent loss. But here's the side of that story we haven't looked at yet. Imagine instead you use the $10,000 to pay off the debt. The market still crashes 30%, except now you don't have $10,000 invested, so when the market eventually recovers, and historically it always has, within a couple of years on average, you're not there for it. You feel safer in the moment, but you also gave up the recovery along with the drop. That's the part a debt-free feeling can quietly cost you. Every financial decision closes one door while opening another. Paying off debt gives you less interest, lower monthly obligations, more predictable finances, psychological relief. Investing gives you liquidity, diversification, potential long-term growth, a stake in the broader economy. Neither list guarantees anything, which is exactly why this was never about chasing the single highest number. It's about building a position you can actually live with. So, back to where we started. $10,000. Pay off debt or invest. If it's high-interest credit card debt, paying it off is usually the easier case to make. You're eliminating a guaranteed expensive cost. If the rate is much lower, the answer gets murkier. Depends on your time horizon, taxes, risk tolerance. And if there's an employer match sitting there, ignoring it means giving up money that was already yours to take. One rule survives almost every version of this. Don't invest money you can't afford to leave invested, and don't hang on to expensive debt just because investing sounds more exciting. The best strategy was never the one that wins on a spreadsheet under one perfect assumption. It's the one that fits your actual life, and the one you can still stick with when things stop going according to plan. 20 years from now, the winner probably won't be the person who found the perfect answer on day one. It'll be the person who made a reasonable decision and then kept making reasonable decisions after that. So, if you had $10,000 today, would you use it to buy your freedom from debt or a piece of your future? The answer depends on the numbers, but knowing which numbers actually matter, that's the real math. So, after all of that, what should you actually do with your $10,000? The honest answer, it depends, but not in the lazy throwaway way people usually say it. It depends on a small set of numbers that completely change the decision: your interest rate, your emergency fund, your employer benefits, your time horizon. We've walked through what those numbers do at 20%, at 5%, at 3%, with a match on the table and without one. You know the mechanics now. But here's the bigger lesson hiding underneath all of it. Your financial future was never really decided by this one $10,000 choice. It's decided by what you do after it. The average American household carries close to $6,000 in credit card debt at any given time, which means this isn't a hypothetical $10,000 problem. It's most people's actual life, on a smaller scale, playing out every month. And the two ways people quietly sabotage the right decision are the two we've already seen play out: spend the freed-up cash instead of investing it, or panic and sell the moment the market dips. A technically correct strategy on paper doesn't survive either one. So if you have $10,000 today, the first question isn't what will make me the most money, it's what is costing me the most money right now. Then, what opportunity am I giving up? And finally, what can I actually stick with for the next 10 or 20 years? That last one is the part a calculator can't answer for you. It can calculate compound growth. It can calculate interest. It can compare returns down to the decimal. But it can't tell you whether you'll stay disciplined when the market falls, whether you'll actually invest your next raise, or whether you'll quietly spend the money you promised yourself you'd save. That's the real battle. Not debt versus investing, but the decision you make today versus the person you'll have to be to keep making it year after year. So don't blindly follow whoever says always invest. Don't blindly follow whoever says always pay off debt. Look at your own numbers, then look at yourself honestly, because that's the variable no spreadsheet accounts for. The $10,000 was never really the question. You were.